So we are going to go through business income. Okay, Hilda has finished the portion with regards to employment income. Now, anything that you carry out, any activities that tantamount to trade, right, it constitute business in nature. You could be a person that's carrying out an internet business or a home-based business, carrying out this and on a frequent basis. So it tantamounts to trade. When it tantamounts to trade, you classify it as business source income. All right? Now, for business source income, you would need to file a Form B instead of a Form BE, which applies only for those with employment income only. All right? Now, if you have a business source income, then only expenses that are wholly and exclusively incurred to generate or produce that income, you can then get a deduction for it. So if you have expenses that are private in nature, all right, and certain expenses that are not allowable under the Act, you can't claim that, all right? And also, if that income is treated as business source, if you have losses from previous years, you can actually carry it forward and offset it against your net adjusted income from business, all right? So that basically is business source income, all right? And because if, let's say, you're a sole proprietor, all right, or a partner, when you receive that income, you have to put it in your Form B, all right? And you have to tax it at graduated rates, all right? And also, if you have business source income, naturally the tax authorities will issue you with an installment payment scheme every year to collect the tax in advance. Unlike when you are an employee, your tax is actually deducted in advance via the monthly tax deduction system, all right? For business source income, they actually put the responsibility to the person to remit the tax via an installment payment scheme, all right? There are 6 installments you need to do within a year. It runs from March, all right, to January, so it's on alternate months. So the first payment was actually due on by 30th of March. So the second payment is actually due by 31st of May, all right? So it runs until 31st of January the following year, okay? So when we talk about business source income, right, we also looked at rental income. Now, for those of you who invest in properties, right, and you actually let out those properties for rental, how do you know whether you should treat it as business source or it's a passive source of income to you or investment source, all right? Now, if you want to treat it as a business source, okay, according to the public ruling that was issued in 2011, you must be comprehensively providing maintenance and support services, okay? What do you mean by providing comprehensively maintenance and support services? What it means is that, let's say you rent out the condominium to an individual, all right? They want to, you are seen as providing maintenance and support services if you maintain, let's say, the stairwell, the staircase, the elevators, the escalators, all right? And if it's a landed property, you're expected to also maintain the lawns, landscaping, the drains, the sewage system. So that's providing comprehensive maintenance and support system for the upkeep of the property, all right? You need to demonstrate that before it can be classified as business source income, all right? If you're not providing this, all right, on a comprehensive basis, basically you just pay, okay, certain maintenance fees, you know, that is not comprehensive enough and it's treated as a passive source of income. So that's why we classify as non-business source. Now the good thing is that previously, all right, before this public ruling came out, you had to be classified as business source income, you had to own certain types of properties, like you need to have 4 properties before you can even classify as business source. So under this public ruling, they make it very clear, so long as you provide comprehensive and maintenance support services, regardless of how many properties you own, you can treat it as business source income, all right? So you have rental income now segregated between non-business source, and business source. So you may have certain properties that you don't provide these support services, so you can classify as passive income, and the other one you can classify as business source income. So within the group, okay, let's say you have 3 properties that you have treated as non-business source. So these 3 properties, if one of them make a loss, you can share the loss within the same group itself, the non-business source. All right? I'll show some examples later. Similarly, for the business source income portion of the rental, if you suffer any losses, you can also deduct within the same group. Okay? And if, let's say, all your properties in the business, which is classified as business source, is all in a loss position, you can carry it forward to the following year, okay, and offset against the income you generate from the rental you generate the following year. Okay? So that's how you classify it. So if you look at this example, this company owns 3 shop houses, all right? So one of the shop houses actually is profitable, okay? And the other 2 shop houses have losses. So within these 3 shop houses, they have been classified as business sourced. So you can actually utilize the adjusted loss to arrive at the net income that's subject to tax. All right? Similarly, if you're an individual deriving income, rental income, on a passive basis, all right, and you may have, let's say in this case, 4 properties, all right, and all the properties except the vacant land is making money. Okay, you rent out the vacant land, but you're not making any money, you're making a loss. So similarly, within this group, the vacant land loss, you can share it and then net it off against the income that you receive from the other properties. All right? Then you can, so from there, you can then derive the net income that's subject to taxable income. Okay? Now, I also wanted to bring your attention to something. When you treat something as a passive source of income, like investment, like rental, you find that your deductions that you can claim against your rental income is very, very limited compared to if you treat it as a business source income. In the case of rental, you can only claim certain things like quick rent and assessment, fire insurance that you pay for the property, repair and maintenance, all right? And also maybe sometimes you engage an agent to look for a tenant for you, okay? After you have let out and then the tenant left and then you need to find another tenant, you can offset that. So it's only very limited form of expenses that you can claim. So let's move on. Let's look at other investment income, okay? How many of you have experience investing in REITs? I'm sure all of you have. When you have distributions made from REITs, they actually issue you what? Like a dividend voucher, right? Okay. What do you see on the dividend voucher? They deduct a certain portion of tax, correct? Now, the tax that they deduct is only 10%, all right? And that tax is actually a withholding tax and a final tax that is paid, okay, by the REIT to the tax authorities once they made the distribution to you. So because it's a final tax, you do not need to declare this income in your tax return at all. All right? And this is also made very clear in the explanatory note to the tax return. So you do not need to declare this. What about distribution made from unit trust and dividends? Okay. Dividend is an interesting topic because prior to 2008, right, when you get dividend vouchers, right, you see that it's actually deducted tax of 25 or 26%, correct? Right? And what happens is that before 2008, you have what you call a frank dividend, where it's taxed at the company level and it's also taxed at the individual level. So there's double tax, right? And you have to claim that tax relief through what you call a Section 110 deduction in your tax return, correct? Now, and then whatever balance, it's possible you get a refund and you may not get a refund. If you think about it, because the corporate tax is at 25% and your tax at the top rate of 26%, you still have to pay 1% tax on the dividends, right? So they eliminated this imputation system with effect from 2008 in phases. So what you have now is a lot of companies are actually issuing the dividends on a single tier basis. Single tier means that whatever taxes that is deducted at the corporate level is the final tax. So what you get in your hands is already exempt from tax, all right? So for single tier dividends, if you see the dividend voucher, the tax deducted is 0. So what you get is already net of the tax paid at the corporate level, okay? So for single tier dividends, you do not need to declare it to the tax authorities as well. So you do not need to report it.